Hello, everyone. Welcome to the webinar today. So glad that you can join us. We are in February, end of February already. We want to look at what's going on for the rest of 2026. What is happening in the multifamily rental market? So we've brought on with us an expert to talk to us about what is going to be happening on the horizon and what's currently happening. What stage of the real estate cycle are we really in? So this will help you hopefully make some plans for the future and feel a little more confident about some of your decisions this year, whether you're going to buy a new property or not. For those of you who don't know me, my name's Alexandra. I'm the Director of Marketing and Education here at the American Apartment Owners Association. As you all are coming in, I would love it if you'd say hi in the chat. I love seeing familiar names in there, and let us know, how long have you been in real estate? Are you new to it? Are you experienced? We'd love to see you all in the chat there. And then also want to let you know we have a Q&A section as well, which is separate from the chat. You can put your questions in the Q&A area, and we are going to be addressing questions at the end of this presentation. We may go over a little on time, just depending on how many questions you have, but we will be sending everyone the recording by the end of day tomorrow, along with the slides and our speakers' contact information as well. So keep an eye out for the email tomorrow if you want to share it with anyone that you know or rewatch. So let me tell you a little bit about our speaker, Austin Bolin. He is a CPA and also a chief exchange strategist at Real Estate Transition Solutions. It's a national firm specializing in 1031 exchange strategies for investment property owners. He is drawing on his background as a CPA, which is great. We love having that. I know we're always asking tax questions, right? So it's nice to have Austin on to share that part, as well as looking at how the investment market is happening. He has so many years of experience in real estate and financial consulting that I think this is going to be really eye-opening for many of us. And his whole experience really comes down to helping his clients navigate the complexities of transitioning from an active real estate option to something more passive. And he is a frequent speaker on this topic. So we are so glad to have you with us, Austin. I really appreciate your time coming on to give us a market update. Excited to hear what's going on. I think I'll learn a few things myself.
Excellent, Alexander. I appreciate the introduction and the opportunity to share with the AAOA community. As Alexander mentioned, today we're going to be discussing, broadly speaking, economic conditions as it relates to investment real estate and a market outlook for 2026. The way we're going to go about doing that is by starting with a look back at 2025, just what occurred throughout the course of the year. We'll then pivot into economist forecasts and predictions and projections for 2026, some of the key trends and themes that we expect to play out over the remaining, call it 10 plus months of the year. We'll highlight a few property types in particular and dive into those at a little bit more granular level. We'll talk about some of the markets where we see opportunity lying throughout the course of the year and in the years to come. We'll do an overview of changes that have been made to the regulatory and legislative landscape. What are some of the regulatory initiatives that have been proposed at the federal level, and highlight a few municipalities or state level regulations as well. And then we'll wrap it all up in key investment takeaways. And of course, as Alexander mentioned, make sure to save time for Q&A at the end of the presentation. Now, one of the 1031 exchange replacement property options that our firm specializes in and works extensively with is what's referred to as a Delaware Statutory Trust, or DST. Delaware statutory trusts are unique in that they are both eligible for 1031 exchange purposes as what's called like-kind property, but also treated as securities by the Securities and Exchange Commission, the SEC. Specifically, they're what are considered Regulation D securities, which means that in order to invest in Delaware statutory trust replacement property, one must be what is considered an accredited investor. Now, typically, an investor is accredited by virtue of having a net worth in excess of $1 million, not including the value of your primary residence, or alternatively by having annual income in excess of $200,000 as an individual, 300,000 if you are married filing jointly, or by holding a number of professional licenses or certifications. Those are not and requirements, those are or requirements. So $1 million net worth, not including the primary residence, income threshold, or professional licenses or certifications. Before we dive into the topic at hand today, a little bit of background on our firm, Real Estate Transition Solutions, or RETS as we're commonly known. We are a real estate advisory firm that really focuses on serving property owners that are navigating the transitions of ownership between, we'll call it the third and the fourth quarter of life. And our whole approach is built on the premise that owning and managing investment real estate is dynamic. And what I mean by that is, of course, physical properties change over time. There's repairs and maintenance, there's capital expenditures. The tenant profile within properties can and inevitably does change. The market conditions change all the time around properties, both at the local level and the macroeconomic level. The regulatory environment is continually changing, often far faster than any of us would like it to. And on top of all of that, owners' objectives are changing as they're going through the various decades and chapters of life. For instance, a younger owner may be more focused on generating appreciation, the increase in value of the properties, whether that's through an active value add strategy. And then an older owner may start to shift toward wanting to have a greater emphasis placed on income generation, stability and predictability of that income, perhaps diversification to lower one's overall risk profile, or starting to place a greater emphasis on estate planning. How do we eventually transition assets to beneficiaries in a seamless manner while doing it in a tax efficient way as well? So recognizing that there is all this dynamicism in play, what we do is we come alongside property owners to first educate them on options they have available. Second is to help them analyze their investment real estate and discuss and determine their objectives, both today and for the years to come, decades to come. And should there be a gap between one's investment real estate that they own and their objectives, then we help to design and execute a transition strategy for their property. Now, fortunately, because we're discussing investment real estate, what you have available to you is the opportunity to rebalance your portfolio, if you will, on a tax-deferred basis by virtue of performing a 1031 exchange. As I made reference to on an earlier slide, we work extensively with passive replacement property options, whereby an individual can exchange into owning a fractional interest of one or multiple large institutional quality properties. And that's often utilizing what's referred to as the Delaware Statutory Trust, or DST, ownership structure. We've been working with DSTs for north of 20 years at this point, have completed close to 1,000 1031 exchanges with our clients, and have just over $1.5 billion of DST real estate under advisement. Now, I'm specifically using the term advisement here, not management, because we do not physically manage the properties, nor do we asset manage them. That's the role of about 35 different large institutional real estate firms who have worked through our firm's due diligence process and we work closely with. We've completed north of 2,000 individual investments in DST properties among north of 300 individual DSTs themselves. Some of those DSTs own a single property within them, others own portfolios of properties within them. So quite a bit of experience to draw upon within the 1031 exchange and the Delaware Statutory Trust space. Quick glimpse here of some of the key individuals on our team. This is just a snapshot of some of the leadership team here. We are actually headquartered up in the Northwest, just outside of Seattle, Washington, and Kirkland, Washington, if you're familiar with the Puget Sound area, with offices down the West Coast in Portland, San Francisco, and Orange County. We serve property owners all over the United States, and we work with replacement properties all over the United States as well. So while that is where our physical offices are located, regardless of where you live, we can work effectively with you. Now, when we talk about 1031 exchanges, most people are familiar with the tax benefits associated with performing an exchange. And in short, that's the ability to defer all the tax, both federal and state income tax, that would otherwise be due upon the sale of a property. And that can be extensive, and that in and of itself is a reason to consider performing an exchange. If one is selling a investment property that has been owned for years or decades and it's appreciated, as well as taken depreciation, which is a tax concept over the period of ownership, there can be a hefty tax liability due upon the sale of a property. However, with an exchange, all of that tax that would otherwise be due can be deferred into replacement property, one or more properties, provided an exchange is performed. Beyond the tax deferral, there's also quite a bit of flexibility as it relates to exchanges. You'll hear a term that's commonly used in association with 1031 exchanges, and that is like kind. The property that is sold and the property that is acquired, the relinquished property and the replacement property must be like kind with one another. A lot of people hear that for the first time and assume that means the same property type, perhaps even the same market in which those properties are located. But the definition is actually far broader than that. The IRS is not focused on the market or the property type, but instead the intent as to why that property is owned. And all real estate held for business or investment purposes is considered to be like kind with one another, provided it is located in the United States. So really the only properties that are not 1031 exchange eligible that most people need to be aware of are those that are held for personal use. This could be your primary residence, this could be a vacation home, etc. You can sell, say, for instance, a single family rental or a multifamily property in California and exchange those proceeds into a different state, a different market, multiple states, multiple markets, and spread it among multiple different property types, if you will. Each property type has its own characteristics, its own attributes, its own opportunities, its own risks associated with it. So this is where flexibility really starts to open up. Additionally, different states, different cities, different markets, they go through their own cycles and have their own opportunities and risks associated with them as well. So you can leverage demographic trends. You can go where you see there being opportunity. You can flee aggressive regulatory environments and the like, all through 1031 exchanges. So with that background, let's talk about the year that was 2025. What happened in 2025? Well, it's a fairly lengthy list that you see here. 2025 was the first year in which we finally started to see some relief as it relates to the Fed rate and interest rates in general. So the narrative that was at play here is, if you recall, go back 6 years at this point, almost to the day when COVID began. And as a result of that, there was a lot of uncertainty as to how the US economy was going to perform and navigate that unprecedented, which is a word that seemed to be tossed around all the time during those months and years, that unprecedented time. And why was that the case? Well, because we didn't know how supply chains were going to be impacted, how labor markets were going to be impacted, how investment was going to be impacted. And ultimately, what the federal government did, for better or for worse, I'm sure there's going to be an abundance of studies done on this for decades to come, is they stimulated the economy through significant liquidity that was injected in various ways. Stimulus packages, reducing the Fed rate down to nearly zero, that then, as a result of that, was a kickstart for the US economy, and that's positive. However, also created an inflationary environment. In order to control or temper the inflationary environment that we started to see play out in 2020, end of 21 and through 2022, then the Fed increased their borrowing costs, their rates that they were applying, what's referred to as the Fed rate. Obviously, there's been a lot of conversation tracking of the Fed meetings. Are there going to be rate cuts? If so, to what extent? But starting at the end of 2022 and into 2023, we saw the most aggressive increases in the Fed rate that have ever occurred from a Federal Reserve standpoint. That increase in borrowing costs put pressure on a number of components of the economy, but especially investment real estate, because there is such a tight relationship between borrowing costs and property values. It's not a one-to-one correlation, but it definitely impacts it. So those rates held, and many people initially expected them to come down fairly quickly. However, we ended up encountering and navigating a higher for longer approach. And this was because while inflation was originally expected to be quote unquote transient, it ended up being quite persistent and sticky. And so we saw inflation that ran north of 5, 6, 7% for a period of time. And then it started to make some movement downward as a result of these higher borrowing costs, kind of pumping the brakes on the US economy, if you will. We didn't see meaningful rate cuts until 2025. So we had just over 2.5 years of higher rates than what we were accustomed to in the 2000 teens and certainly in the 2020s. There were three rate cuts that occurred in 2025, September, October, and December Fed meetings, respectively. And there's the expectation, or one could say the hope, that there will continue to be some level of rate cuts in 2026 as well. However, they're currently on pause on that front. What happened to the US economy as a whole in 2025? Well, GDP was stronger than most people expected it to be. If you think back to right around this time last year, that's when tariffs were being implemented globally by the US. And many people were concerned that that could either lead to more inflation or it could serve to be a drag on economic growth. That didn't actually prove to be the case. So we posted quite strong GDP figures in 2025. Here we're pulling figures through Q3, but 4.4% year over year GDP growth, which was quite strong, stronger than most people expected. We saw a positive movement on inflation. Inflation moved down from 2.9% at the end of 24 to 2.7% by the end of 25. While that is headed in the right direction, know that the Fed's target is to have inflation sit plus or minus right around 2%. And the Fed has two mandates. Their mandates are to be sensitive to and manage inflation while simultaneously manage the labor markets, effectively the unemployment rate within the US. What happened in the capital markets and the stock market? Well, significant growth in the S&P, and again, beyond what most people expected. So 17% return from January 1st to December 31st in the S&P 500. But with a major caveat, and that is the fact that most of that share price appreciation and expansion in the S&P 500 came from the tech industry, specifically tech companies that were really on the forefront of adopting the AI boom. Is that going to stay around? Well, 8 weeks that we're into 2026 to date suggests that that may not be the case. It might have been a little bit too frothy, and there's since been a pullback, and the markets are more or less flat from the start of the year, and a pullback within those sectors in particular. From a lending standpoint, one of the positives for investment real estate is we saw a lot more appetite and interest for lenders coming in and starting to originate new loans for real estate. Why that's important is not necessarily from a benchmark rate standpoint, say the 10-year US Treasury, but as there's more competition from a lender standpoint, then that means lender margins start to compress. And that is very much a dynamic we saw play out through the year. Passage of the One Big Beautiful Bill Act, which always brings a smile to my face whenever I say that or read that, had some key tax provisions that we'll talk about in more detail, specifically benefiting investment in equipment, capital expenditures, and real estate acquisitions. And then, of course, this narrative of just this absolute frenzy as it relates to AI spending and the infrastructure implications for that as well. Here you're going to see a number of charts. This may be a little bit small for some of you to read, but I think it's worth spending a little bit of time on. And the 10-year US Treasury is the primary benchmark on which commercial real estate financing is derived from. So as of right now, we're sitting just a hair above 4%, which is pretty in line with the 10-year historic average. It's lower than we saw 2 years ago. It's quite a bit higher than we saw 5 years ago. But when we draw in the back half of the 2000 teens, it's more or less in that 10-year average. Expectation by most economists here, what we're drawing upon is the Wall Street Journal's economist survey that they do on a quarterly basis, is that we will see the 10-year Treasury start to work its way up. Federal debt has an implication for that and a bearing and movement on the 10-year Treasury. Economists' projections and hypotheses as to what's going to play out over the next 5, 10 years has a bearing on it. Usually, when there's some level of instability in the global economy, there will be a flight to safety, which the 10-year Treasury is viewed as a very safe investment, risk-free, if you will. And so, in turn, that can put downward pressure on the return, the yield on the 10-year Treasury. What's expected from a GDP standpoint? While 4.4% was a fantastic figure in 2025, there is the expectation there's going to be some cooling throughout the course of the coming year. So most economists' consensus, there's a wide range here, but many are saying that it'll be about half of that. And 3% rather is kind of the target for sustainable GDP growth. Anything in excess of that is positive. Anything below that is kind of falling into, you'll hear the term anemic be used, where yes, it's growth, but it needs to be growth that's outpacing inflation for the economy to be truly expanding. 2.2% with 2.7% inflation would actually be a slight contraction on a normalized basis. CPI, there you see the note here as it relates to where inflation is expected to go. So those two could end up being a wash. These figures were just updated as of last week. And then unemployment starting to move up. That's a trend that we've seen play out over the last 3 quarters or so. Not a significant increase in unemployment. Still well within a manageable range from a Fed standpoint. I think labor participation is something that should get highlighted. There is still a healthy portion of the US labor force that is more or less sitting on the sidelines right now. And if they are to get back into the labor force, but not have open roles available to them, then we could start to see that unemployment figure move up. Additionally, it's worth noting that most of the job creation that occurred throughout 2025 is coming from two primary industries. It's from healthcare and hospitality, which is largely due to aging of America, key demographic trend that's playing out right now, the baby boom generation, plus or minus 1 decade, getting older, requiring more services, creating more demand for healthcare jobs. And the layoffs that we've been hearing about and seeing and are drawing the headlines are largely white collar jobs. So high paying jobs, north of often $100,000 annual income, well above the median income in the US, which could have an impact on consumer sentiment and demand for consumable goods. Now, I mentioned more lenders being interested in participating in the market today. Lenders were very wary in 2023, 2024, because they had originated so much debt at historically low interest rates. You can see that dip there. The shaded area within this particular chart is the 10-year Treasury. And in 2020, 2021, 2022, when the Treasury was sitting anywhere between 1 to 2%, there was a high volume of loans originated. And the lenders were having to hold those on their balance sheets, hoping to have the opportunity to redeploy capital at higher borrowing costs. But lenders often thrive in environments where there's more stability, more predictability. They don't have to build as much margin into their loans because they feel more confident in where those interest rates are going to be years down the road. There's been a tightening of the band in terms of the spread that various categories or tiers of debt will charge, which implies that there's more competition in the market. There's more confidence in the market as well. And that's something that we will hopefully continue to see play out over the year ahead of us. What about transaction volume? So here we have a chart that shows a variety of property types. office, multifamily, retail, industrial properties, and the like. And what was the year over year change? Again, drawing on Q3 information here, because Q4 is not yet available, unfortunately. But what's the change in total volume of real estate transacted within those respective property types? As a percentage, in terms of a single property type, we saw the biggest increase in office. What does that mean? Well, it's a combination of likely two things. One, distressed sales. These are sales where a property has a debt maturity, there's a foreclosure, whatever it might be, that then leads to a forced sale by the owner of that property. The second is renewed confidence in that market, perhaps starting to feel where the bottom is in terms of values and more appetite for investors to say, given the current price point, we feel comfortable taking a swing at this because now it's been not entirely de-risked, but it's at an acceptable level of risk or acceptable return profile for that commensurate risk to actually deploy capital. Multifamily, slightly different dynamic here. We'll touch on multifamily in more detail in coming slides, but we did see a significant uptick in terms of investment volume, about a 27% increase quarter over quarter, comparing Q3 24 to Q3 25. And then the other property types, not as large of differences. There's always going to be some ebbing and flowing in what property types are in vogue and where there's sensed opportunity. Large transactions obviously distort these numbers, but fairly stable across the board for the other primary property types. Now, just a quick kind of zoom out highlight. I mentioned that different property types have different return profiles. For instance, industrial properties may not have as much appreciation potential behind them. However, they have a profile that lends itself towards stability and predictability of the income stream, especially when we're talking about large single-tenant industrial properties with corporate guaranteed leases, double, triple, absolute net lease properties, and importantly, investment grade tenants. So very high likelihood that that tenant is going to be capable of and will in turn make their rent payments throughout the term of the lease, which might be 10 years, 15 years, 20-year leases. You contrast that to shorter duration lease properties, multifamily, senior housing, student housing, self-storage, hospitality being the best example because nightly rental rates, nightly lease structure, if you will. They're more ebbing and flowing. It's going to be impacted by current economic conditions, more appreciation potential historically, but also important to recognize that there can be some fluidity in that income available for investors as the property performance changes month to month, quarter to quarter, year by year. One is not necessarily better than the other. And in fact, there's often, for many people, a place for both of those to be represented within an individual's portfolio. The question often becomes to what extent, what's the blend, what property types are represented, where do we have supply that is equal with demand or in excess of demand, or perhaps more demand than supply, which creates a rent growth environment. Now, the approach that we take from a due diligence standpoint as it relates to DST properties really consists of two layers. And why I'm showing this particular slide and speaking on it in brief is the fact that whether you are working with large institutional properties whereby investors can exchange into owning a portion of those properties, or you're acquiring your own property that you own the entirety of, what would be considered a fee simple acquisition, it's critical to have a defined, structured due diligence approach to take. And from our standpoint on the DST side, what that consists of is first and foremost, it's evaluating the operator. If we're not comfortable with the operator, we don't care how good the real estate is. It's as simple as that. And we go through an extensive, typically around 6-month process when evaluating a institutional real estate company to determine whether we're going to then take that next step of actually underwriting each and every property that they acquire. Within the property underwriting and due diligence, we need to be looking at the tenant, we need to be looking at the market, we need to be looking at supply and demand and risks and opportunities, adequacy of insurance policies, reserves, financial projections, loan terms, et cetera, to determine whether we feel like there is a high likelihood of achieving a favorable outcome for investors when that property is eventually sold. It's also important to know the characteristics of the investment and the return profile such that it can be properly presented to clients whom we are working with. If you're doing your own analysis, you don't get to leverage the work that is done by firms such as ours. But again, as I noted, it's critical to have a diligent and structured approach that you take to make sure that you don't ultimately overpay for an asset, or sometimes just as bad as acquiring a property that's really just not a fit for your unique objectives. Now, what we are showing within this particular slide here is the 12-month change in values among property types, and then the associated cap rate with those property types. That's what's demonstrated in the chart over on the right. 12-month change in value is fairly straightforward. I think most people understand that as soon as they hear it. I'll do a quick explanation of a cap rate for those of you whom that may be a new term. So a cap rate is a percentage that the net operating income, the annualized income that a property generates, less the annualized expenses, not including any debt servicing. So we're able to normalize between properties that are owned free and clear and those that are owned with leverage because we're removing debt service. That annual income less operating expenses gets us to NOI, net operating income. And when you take NOI and divide it by a cap rate, so divide it by 5%, divide it by 6%, that is in effect multiplying it by the inverse of that. So a 5% cap rate, 5% goes into 100, 20 times. Taking an NOI of, say, 1 million, dividing it by a 5% cap rate is the same as multiplying it by 20. As cap rates move down, then in turn, the value of the property increases relative to the income that it produces. So what you can see here on this chart is the cap rates, average cap rates that are in play for two tiers of quality, if you will, between these individual property types. The lowest cap rates are apartments. Why is that the case? Why does an apartment building generate the lowest income relative to the value of the property? Well, because there's an expectation when you see that that income will grow, and in turn, the property will appreciate in value. The highest cap rates that you see here are office. That is effectively a risk adjustment that is in place for that particular property type, coupled with, we'll call it the unpredictability as it relates to tenant improvement allowances, operating expenses, future demand, and the like. So what were the changes that we saw year over year? Apartment values didn't change a whole lot. Industrial properties did not either. We saw a meaningful amount of appreciation within senior housing. That's largely due to excess supply that was present in the early 2000s, largely being worked through with this associated demographic trend moving forward of more people needing senior housing options and lack of supply to serve that. Retail is very much having its moment. It's kind of a quiet success story, if you will. I hear from a lot of owners who say, it seems like brick and mortar retail is dying, and I'm not interested in investing in that because eventually we're going to buy anything and everything online. Well, that is far from the case. In fact, we've seen a resurgence in demand for brick and mortar retail over the past 5 years, really. And it's due to a number of factors, one of which is the fact that for the large credit tenant retail properties, with this kind of omni-channel, multi-channel approach where you can buy goods in a Target store, you can buy goods online from Target.com, or you can purchase online and do in-store pickup. It's really creating this dynamic that makes brick and mortar retail essential. And these already existing locations serve as de facto mini fulfillment centers within the company, the retailer's overall footprint itself. And then office values not changed significantly, but I think a slight increase, as I mentioned earlier, in kind of the long-term prognosis and confidence in that market, such that we saw an uptick in value, or excuse me, uptick in transaction volume with more or less stable values. A little bit bigger picture, longer term view of what's happened with property values over close to the last 20 years, 19 years here in particular. So what you see here on this particular chart is indexing property values by property type. What I mean by that is all of the values start normalized at 100, and it's showing the change in those individual property types over the years from 2007 to 2026. Industrial is the clear winner. Industrial was also somewhat of a sleepy, quiet, non-sexy property type throughout much of the 2000 teens. And then largely as a result of COVID as one, and then the focus on onshoring as a second, then you saw a surge in industrial demand. Large industrial users recognized that they needed to decentralize their supply chain and their logistics networks. There was an emphasis placed on production and manufacturing and modification and distribution within the US. There were issues that ran into from a port and a labor negotiation standpoint, which created some added complexity and cost and unpredictability for imports. And then you have tariffs as well. A significant amount of industrial was developed and began construction in the early 2000 teens. That, coupled with interest rates, served to bring values down some in the early 2020s. But since we've seen some stability. Multifamily, strong storyline there as well. Rampant rent growth in the early 2000 teens. Again, interest rates impacted values, oversupply impacted values. We've more or less found some stability and are very bullish on what the coming years could look like within multifamily apartments. And then the others, they have grown at times from a value standpoint, tapered off at others. Again, felt fairly stable throughout the last 12 months. But in general, if you remove industrial, property values today are more or less akin to, depending on the market, depending on the location, pricing somewhere between 2018 and 2020. And real estate goes in cycles. We know that. We understand that. It could be a 5-year cycle. It could be a 7-year cycle. I mean, in the case of the 2000 teens, it was a 10-year cycle, which was historically long. And it does very much feel like we are in the early innings of another positive cycle moving forward. If you are contemplating exchanging into a property, this is a good slide to draw off of to kind of build a high-level framework of what you should be looking at when considering markets and properties. Again, if you are acquiring your own property that you plan to have your own acquisition process, your own management process, all of this is on you, which is totally fine to do. Some people prefer that. Some people feel fully confident in that. Some people, on the other hand, would say, I'd like to leverage the expertise of these large institutional real estate companies, have better access to information, more granular knowledge of individual markets, and have the capital to be able to deploy it and move quickly, which can be done in a 1031 exchange process or transaction through utilizing Delaware statutory trust replacement property. You also get the added benefit of a second set of eyes doing their own independent analysis, which is our 5-person internal due diligence team, to make sure that everything has been verified, stress test, adequacy is always assessed and considered, and then potential outcomes or scenarios are ran through to determine what that could look like from an investor standpoint. Another interesting slide to note, and I think that some people come in thinking, every DST is homogenous, or that if I'm going to exchange into DSTs, then I have kind of an off-the-shelf design of what a portfolio would look like. But you can actually tailor DST replacement property portfolios to reflect the individual exchangers' objectives. So on this slide, what you can see is just two illustrative examples. One, more of an income stability focused portfolio. Second, more of a growth focused inflation hedge portfolio. And there's a different mix of property types included within those respective portfolios. We're just looking at it at that 10,000 foot view here by property type, not specific properties themselves. But know that a DST portfolio can be tailored to reflect your specific objectives for the years to come. And that's a good segue into our first poll question that you can see up here. That question is, and speaking about DSTs specifically, in 2024, there was just north of $5.5 billion of equity invested in DST properties. What is your best guess? Don't expect anyone to get the right answer here necessarily, but your best guess as to how much equity was exchanged in the DSTs in 2025.
Great. Yeah. So take a look at the poll question, guys, that's pulled up. I would love to hear your responses. We have just a few of you who have answered. So I want to give everyone an opportunity to give their best guess. I love little quizzes like this. I hope we'll find out something surprising in the next slide. It goes from just a little over 6.78 billion, or I should say 6 billion, to all the way up to 8.41 billion there. So go ahead and pick what your best guess is. And I'm going to show the results in just a few more seconds. So last call to put in your guess. Okay, I'm going to go ahead and end the poll and let's share the results. So number one guess was 7.89 billion. And then we have 6 billion and 8.41 billion after that.
Pretty close. Okay. I like to see that. So the answer to that is actually what you see here, $8.4 billion. So significant increase in investment volume, specifically within the DST structure when comparing 24 to 25. Why is that the case? Well, the industry continues to mature. There are more and more reputable institutional real estate firms that are structuring DST investments. That's one. The second component is the fact that many investment properties that are sub-institutional in nature, let's say ranging in value between 200,000 all the way up to $20 million, are owned by individuals that are aging. And they're recognizing that there are benefits of continuing to defer your tax liability until eventually they or their spouse pass away, at which time all of that deferred tax is eliminated. The question then becomes, what ownership structure, what property types, what markets should I be invested in to bridge that gap? Some people make that decision that the time to exchange into DSTs is at 50 years old. Others hold out until they're 75 years old or even 80 years old. But for many people, that will be an ownership structure they use for those final decades so that they can be passive, they can have diversification, they can leverage the experience of institutional real estate firms, and then eventually realize the benefit of that step up in basis. This pie chart just shows a quick snapshot of currently available DST equity. It's a little bit skewed from what we typically see, where about 60% of it falls within multifamily. Then your next primary property type is going to be industrial at 14% of the 3 or so billion of currently available equity in the marketplace today. Usually that's sitting at about 40% multifamily and 30% industrial, with then a disbursement among the remaining property types you see listed here. It's a little bit thrown off right now because we are expecting some large industrial properties to be made available in the coming 2 to 3 weeks at this point. So with that backdrop, let's pivot into discussing specific property types and associated markets. And there's two property types that I'm going to highlight in more detail. It's multifamily, i.e. apartment buildings, and industrial. What's the narrative? What are the themes that have played out over the past few years? Well, multifamily went on an absolutely tremendous run throughout the early 2020s, 2020, 2021, 2022. We saw a significant amount of migration around the country We saw home values appreciate, which made the value proposition for renting that much stronger. We saw rent growth that came as a result of population growth in markets and that relocation. But then because interest rates were artificially low effectively in 2020 and 2021, early 2022, we also saw a significant amount of new construction begin. And ultimately, that construction began to deliver completed buildings, new units available to lease in 23 to begin, mostly 24 and into 2025. As that supply began to deliver and simultaneously interest rates increased, understanding that many of these developers are using variable rate, meaning floating rate construction financing, they were highly motivated to lease the buildings up as quickly as possible and sell the properties before their borrowing costs pretty much ate into any and all returns that they had underwritten for. So developers accelerated their construction timeline. They were willing to offer concessions to get their buildings leased as quickly as possible. And what that did is it put downward pressure on rents in most markets around the country, with the exception of a few coastal markets and most of the Midwest. Sunbelt markets very much impacted by this. Many West Coast markets very much impacted by this, Mid-Atlantic as well. Not only do we have a period of time with little to no and sometimes even negative rent growth in 23, 24, and 25, but on top of that, we also had a dynamic where operating expenses, taxes, insurance being the worst offender, utilities, labor costs were increasing well beyond that of inflation. And so what that did is it compressed distributable cash flow for multifamily owners. Now, what would it take in that scenario to create stability in the market? Well, you need moderating of supply. And fortunately, from an owner standpoint, as rates went up, it no longer became as economically feasible to build new multifamily. So we are expecting to see, and there's a lot of data sets that support this, a fraction of the new supply that was delivered over the past 3 years being delivered in the coming 3 to 4 years, which then should lead to stability in the market, a resumption of rent growth, and then hopefully some outsized rent growth, some cost recoupment, if you will, throughout 26, 27, 28, and 29, depending on the markets that we're looking at. Just to give you a feel for how much supply was delivered, the 10-year historic average for multifamily supply delivered on an annual basis across the country as a whole sits right around 380 to 420,000 units. We saw as high as 600,000 units being delivered, so about 50% more supply than historically had been the case. And that created a glut. But we know that there is this shortage coming up. And it's this really interesting dynamic where I like to use this analogy of, from a supply standpoint and digestion of supply, it's almost like you have very little food in the pantry, but just enough to make one large meal. So yes, technically after eating that meal, you're full and you're feeling bloated, but there's nothing behind it. And that's more or less the dynamic that we're looking at right now for multifamily. What that means is it could be a great opportunity to be buying into multifamily and taking advantage of that next cycle, especially because home values have remained elevated. Borrowing costs are still high. We just broke today, actually, 6% for the average 30-year mortgage. But for most people, that's not approachable. And so in turn, they will continue to rent. From a market standpoint, looking at individual market fundamentals, the amount of supply, the demographic trends, the diversification of the employers, the livability, the regulatory environment, all the factors that need to be considered in evaluating a multifamily market. There are a number that we feel like are very strong candidates for this next, call it 5 to 7 year cycle that you see highlighted here. What's important to note whenever evaluating individual markets, though, is no market is perfect. There are always some positive dynamics, and then there's risks associated with it, whether it's climate risk, whether it's the regulatory risk, whether it's concentration of a industry in that particular market that as that industry goes, so could demand in that market. So here you'll see just a kind of a glimpse of three markets that we're highlighting: Miami, Dallas, Fort Worth, and then Tampa. The score assigned to those markets, but also you'll note that not every criteria that they're being evaluated on is always going to be a green light. So again, just giving you a little bit of color to the approach that's taken when considering where to invest. Industrial had a somewhat similar dynamic. This is the second property type that I'm going to highlight here. But industrial is a property type that has many subcategories within it. For instance, you have large single tenant industrial properties. Think your Amazon fulfillment centers, your million square foot facilities that could be leased to your large industrial users. Often these are for distribution purposes, sometimes manufacturing, sometimes cold storage, sometimes AI, which has drawn on a lot of the and created a lot of the demand for industrial as of late. It certainly increased replacement cost as materials, concrete and steel, namely, and cabling have been allocated toward AI properties, data centers essentially. But there are all these subcategories within industrial, and much of the supply that we saw delivered in industrial that looks like it created a sense of oversupply is on the higher end of that spectrum. It is these spec 1 to 2 million square foot facilities, occasionally slightly below a million square foot facilities. And when those buildings are built on a spec basis and not leased up, it can really start to distort how we look at occupancy within a market, because occupancy is typically quoted on a per square foot basis. How many square feet are available? Is it 4 million square feet? Is it 5 million? Is it 1 million square feet? And if you deliver a 1 million square foot facility without a tenant, you're going to throw those numbers off in a market that might only have 50 million or 30 million of total inventory inside of it. There are other property subcategories, I should say, within industrial, such as multi-tenant small bay industrial, where it's very tight, very high occupancy, high tenant retention, high likelihood of renewal, and have continued to see rent growth throughout. And we would expect this to continue because I don't see this emphasis on onshoring domestic job creation, the kind of national security interests associated with production occurring in the United States. I don't see that changing over the coming decade, regardless of who is in power in Washington. I think that's going to be on both sides of the aisle. There's going to be a continued focus on this. Industrial has been very resilient from an income stability standpoint, and that's positive. But also different considerations that we need to look at when evaluating individual markets. It's not so much about who are the employers in the market, how are the schools, what does tenant amenities consist of, what's population growth look like. Instead, it's more how does this market, this particular location fit in a broader overall logistics network, access to ports, to interstates, to a labor market to a certain extent, to railways, accessibility, tax incentives. Is it a business-friendly environment? Energy costs are a major consideration. So nearly a completely different criteria than what the lens that you would need to take for multifamily purposes. And similar narrative here, highlighting three markets, Miami again, and as well as Boston and Houston. Even though these are three markets that have high scores, they're not perfect across the board. There's always going to be some consideration, whether it's on the climate side or the regulatory side, congestion side, median income side, and the like. Now, lastly here, let's pivot over to the regulatory and tax changes that occurred throughout 2025, some of the expectation as to what will occur in the coming year. I made reference early on to the Big Beautiful Bill. What did that bill do? Well, generally speaking, what it did is it made permanent many of the key tax provisions that were originally implemented through the 2017 Tax Cuts and Jobs Act. the fact that we've had, more or less two comprehensive tax reform packages in the last decade is pretty amazing because historically, that was a once every 20 or 30-year cadence. But we saw the corporate tax rate, the reduced corporate tax rate through the Tax Cuts and Jobs Act made permanent. We saw immediate expensing, bonus depreciation for capital improvements, capital expenditures, real estate acquisitions made permanent. Those are critical for investment real estate. So they offer significant tax incentives then to be able to shelter the vast majority of the income or all of the income that's earned from real estate, as well as incentivizing companies to make capital investments. Separate from the big, beautiful bill, we also saw a settlement that many of you may have seen in the news as it relates to algorithmic pricing for multifamily properties. There was a accusation that companies such as RealPage were price fixing more or less on apartment buildings, largely Class A, large institutional apartment buildings around the country. Ultimately, the named parties in the lawsuit said that they had no wrongdoing, yet they agreed to settle with the Department of Justice on that, and then put some guardrails in place in terms of information sharing among properties. So they're more siloed and operating on an independent basis. The CHIPS Act, major stimulus act coming, focusing specifically on semiconductor manufacturing and the associated chip logistics network to try to move as much of the chip production from countries such as Korea and Taiwan and Singapore to the United States. And this is really a national security play here, specifically as it relates to cutting edge chips. I'm less concerned about the chips that you see in your TV remotes or your Bluetooth headphones and the like. Much of this focus is on the more innovative, small nano wafer technology. But what that leads to is projects such as that which you're seeing in Columbus, Ohio, in Boise, Idaho, in Phoenix, and those are with see Intel, respectively, Micron, and Taiwanese Semiconductor Manufacturing Corporation. These fabrication facilities that are being built are massive. 2 to 10 million square foot facilities can run anywhere from 10 to $100 billion to build and are sucking in a lot of concrete, a lot of steel, a lot of labor, which is driving up costs to build new industrial properties, new commercial office properties, and the like, which increases replacement cost and then supports other property values. And then 2025 saw a record volume of legislative changes on a landlord-tenant basis. Most of this is handled, as I'll touch on the coming slide, at the municipality level, occasionally at the state level in more called progressive states, such as those on the West Coast and in the Northeast. But it is a focus, and I think many lawmakers know that while we have not had significant rent growth over the last 2.5 years, depending on the market we're talking about, the expectation is that will come, and they're trying to put some guardrails in place to make sure that we don't go back to 2020, 2021 environment where we have 8, 10, 12% year-over-year rent growth. Now, are they going to be able to completely get away from that? Definitely not. I would personally prefer, and I think most economists would agree, that the more supply you have, that's the best moderator of rent growth, as opposed to putting artificial price controls in place. Most people joining us today would agree with that as well. But we would expect to see eviction law changes, criminal background check changes, tenant screening criteria changes, deposit and fee changes, and then in some markets also having some benchmarked rent control that comes through as well. All right, so over the next few slides, what I'm going to show, and I'm going to move fairly quickly through these, just to give you some overall context as it relates to markets to consider investing in around the country. I'm going to show a number of US maps that highlight different components. First one we're going to look at is the tax structure in place on a state-by-state basis. So specifically what we're looking at is capital gain tax, which is often the exact same as the state income tax rate, with a gradient on this slide. If the state is gray, it's a non-income tax state. If it has a lighter shade, it's a lower state income tax, and the darker that gradient gets, then the higher the tax. It'll come as a surprise to no one, I'm sure, that California is the darkest side here at 13.3% state income tax. What you see in the Northwest and the Northeast, not all that far behind. There are a handful of asterisks after Washington, because technically, as it stands today, Washington real estate sales are excluded from their capital gain tax, likely something that we'll see in the future, change in the future. Next slide here is going back to that regulatory environment, looking at on a municipality basis, how unfavorable rather, to favorable the regulatory environment is from a landlord standpoint. Again, there's a common theme here where if you look at your West Coast and Northeast markets, those are the least favorable from a regulatory standpoint. Whereas the core of the United States, the Sun Belt, the Midwest, it's a much more balanced, reasonable environment. That's going to prompt our next poll here because our coming slide is going to talk about demographic changes and migration state to state. So the question that we have here is, which states are likely to lose the most population throughout the United States based on their tax and landlord tenant policies? And I would add to that, it also relates to livability and affordability and employment opportunities. But what state do you expect to have the largest outbound migration?
Okay, I am going to post the results in just a few seconds. I'll give you all just a 5-second warning here to put in your answer. It looks like a lot of you agree, but there is a couple that are tied here. So let me go ahead and show you the results. So California in the lead, New York, and then Texas. Interesting.
Perfect. No one said Washington. Okay.
No.
Smart people here. So let me show the results here in terms of state by state. Those of you who said California, they were absolutely correct. I could see why someone would say Texas because there was so much population growth in the early 2020s that one could expect the pendulum would start to swing the other way, but they are actually expected to still continue to grow. And this is looking back here specifically at 2024. Now, one caveat to this data set. Census data, US Census Bureau data, is of course the gold standard as it relates to population change. However, as all of you know, the census does not occur every single year. And so where do we go to get this information in those in-between years? And it's actually through primarily moving services. So it's kind of extrapolating trends based off of one-way moves that you'll see from the van lines and the U-Hauls and the like. A little bit of rental car data involved in there as well. But that's what gives us the information on a year-by-year basis that then we can use to fill in the color between the censuses occurring every 4 years. California, it's worth noting, with close to 250,000 of outbound migration, is a reversal of a trend that lasted about 70 years. Which is pretty wild to think about, that they had 70 consecutive years of continuous inbound migration from various sources, domestic, international, you name it. But people have been leaving the state in record numbers, sometimes just across the border to Nevada, a non-income tax state, no estate tax, lower price point. Many retirees moved over, still commutable distance to go see the children and the grandchildren in Southern California, wherever they might live. Many moved to the Sun Belt, to the Mid-Atlantic, to your North Carolinas, your South Carolinas, Mountain West as well. We will expect to continue to see this, especially as taxes continue to go up, and there's kind of a doubling down on taxing the existing tax base or the remaining tax base that much harder. Other states, not as big of swings. But these demographic trends very much do have an implication for all property types in terms of what's the opportunity in the years to occur, because you need people there for the most part, with maybe the exception of AI data centers, to actually drive demand for that property being in that particular location. The upcoming slide we have is going to be population forecast over the next 25 years. These are kind of fun slides and data sets to draw off of for quiz questions. So that's why you're seeing a number of them here. But the question that we have is the current US population is currently sitting at approximately 340 million. What do you expect the projected population to be for the United States as a whole in 2050? And it looks like these results have already shown up here and much more dispersed among everyone. We've got some 400 millions here. That would be a significant growth over 25 years, but I like to see that. And the answer to that, as you'll see, and this is a little bit harder to see on this particular slide because there's a small table here, it's actually sitting at about 372 million. So that's a 9% change. It's going to be a combination of birth rate, of course, and inbound migration net against outbound migration. You do have a baby boom population that is the largest generation that's going to age through. So that's worth noting that impacts those figures as well. And then it shows within this particular visual, it shows the projected change state by state. Now, I would not run with looking at state level population as the sole criteria because one item to know, one state to note, you have Ohio sitting there just to the east of Indiana, west of Pennsylvania. While yes, we may see an expectation for a overall decline in state population, there is one particular market within Ohio, Columbus, Ohio, that is growing significantly. Diversification of employers, financial services, insurance. You have data centers located there. That is a market that will likely grow even though the state's overall population may decline. You could have a similar dynamic in play in Idaho or Washington, where Boise or the greater Seattle area may grow, but the state population may not grow at the same rate or it may come down. So just encouraging everyone to drill in at a more granular level, but this gives a nice snapshot of what migration is expected to look like over a 25-year period. And you can capitalize on these opportunities by virtue of exchanging into properties located in those markets. Now, it may feel daunting as a property owner to exchange into, let's say, Tennessee or the Charlotte, North Carolina market, not having had direct hands-on experience and boots on the ground management there. But do keep in mind that by leveraging DST replacement property and in turn the institutional real estate sponsors and our firm's due diligence process, you can access these markets and the opportunity that comes with those markets without having to be hands-on yourself. And this just shows you a quick visualization of that concept. It's very common for property owners to say, while I may not leave California myself because my community's here, my roots are here, my family's here, and the like, and I probably love the climate, I wouldn't mind investing in some of these markets and in different property types and having that diversification and taking advantage of those opportunities. Very much feasible with the DST structure. So last question we have here. If you are contemplating or in the process of selling a property, what is the exit structure that you are most interested in? Options here being Delaware statutory trust, not yet sure. Fee simple property, meaning you're acquiring your own property, or ultimately recognizing your tax liability.
Yeah, and I'll just leave this one up for a while as we close out since we are a little over time.
Sure.
I also know you have some great resources. So, in case anyone has to go, I wanted to post those in the chat for you all. But I will be also sending you this in the email tomorrow that includes the recording. But they do have some great guides and also free consultation link, which if you go to your chat, you should be able to see in there. I'll let you keep
Perfect.
going.
Well, here's just a quick wrap up of some of the concepts that we discussed today. Expectation, we'll see a little bit of downward movement on borrowing rates. Economy is still expected to grow, albeit not at the same rate we saw last year. Inflation, progress continues to be made on that. Hopefully that will continue to play out throughout the course of the year. Modest stock market gains, but likely not in line with what we saw over the prior 2 years. We'll still likely see some policies that are going to impact investment real estate. Say, for instance, the potential ban that may be passed on institutional ownership of standalone single-family rental properties. And the current environment for commercial real estate feels stable with very much visible green shoots that bode well for entering into the next cycle. The last item I think is a unique element that is worth highlighting, and that's this whole concept of value arbitrage. If you own a property that hasn't had a 10 or 15 or 20% pullback on values compared to where it was at what we now know being peak pricing in, say, 2022, maybe it's because it's a unique property, could be a single family rental that's a different buyer profile for. There's very much an opportunity to sell and exchange a property like that into property types and markets where there has been that pricing reset. Think selling your Amazon stock at 300 and then being able to buy back in at 220 or 240 or whatever it might be, and then riding that next cycle. So just planting that seed there, because that's something that we've seen a number of owners do that really bodes well for their potential returns over the coming years and decade. Alexander, to your point, additional educational resources. If you have any questions about today's content or would like to discuss your specific situation, we're always happy to have a complimentary consultation. You can do so by calling us directly or by visiting our website, where you can actually schedule directly on the calendar of one of our 1031 exchange advisors. They can share more about the work that we do, the DST structure, educate you on options, learn your objectives, and the like. For those of you who would like to see illustrative examples of properties that have made it through our firm's due diligence process, you can do so by visiting our DST marketplace. Anyone can see closed properties that are not available for investment any longer. And if you are soon to be or in the process of an exchange now, you can request access to see currently available properties. There you'll get a feel for the size and caliber and quality of the properties that make it through our firm's due diligence. And then higher level overview of the DST structure, the history, the mechanics, some of the strategies available using DST replacement property. Great way to learn about all of that is by downloading our guide to investing in DSTs. This is a free 28-page guide, PDF format, that you can find on our website as well. And then lastly, webinars are a near weekly occurrence here at RETS on a variety of topics, broad and narrow. We'll be doing an upcoming deep dive into DST portfolio design here at the early part of March. And then we also make all of our webinars available on demand that you can watch recorded versions at your leisure at a time that is convenient for you. So Alexander, that's all I have on my end. Happy to field any questions for a few minutes that folks may have, but thank you for the opportunity to share.
Absolutely, guys. You can put your questions in the Q&A box. We'll just take a few questions before we end here today. So the first question is from Nicholas. What is causing the fluctuation in cap rate?
Well, cap rate is the percentage that it's divided by in order to get to that multiple is really a reflection of a number of variables. So you can never isolate it down to one sole driver. Borrowing costs, expectation about future demand, expectation about future supply, and risk profile of the investment are probably going to be your four primary factors, but those are always in play in one shape and form. I would say most people would say that if you were to draw one theme and highlight it and say this is the majority of it, it's the interest rates, it's the borrowing costs. As capital becomes more expensive to borrow, then in turn you can justify paying less for a property because you're still trying to back into a certain return. Modeling that out and showing it's a lot easier than verbalizing it and demonstrating it, but that is probably the primary driver with all those other factors wrapped around it.
Well said. Yeah. Frank has a couple of questions. One is, do you have UPREITs?
We do. Absolutely.
Amazing. And also, what about mineral rights real estate? Are they available in the Gulf of America?
Good question. So mineral rights are something that are eligible for 1031 exchange purposes.
Mm.
Our firm does not work with them because we focus and put all of our resources behind kind of true to form real estate, if you will. But it is exchange eligible. It can be acquired in a fee simple structure or in a portfolio structure, royalties as well, water rights as well, but not an area of specialty of ours. I think in part, while we've considered it, there's a depletion component associated with mineral rights, and you're also subject to commodity prices, which adds a whole nother variable that is unpredictable, based off geopolitical and policy and the like. So we have not worked within that, and in part that's a reflection of the fact that our client profile that we serve is familiar with and likes real estate and typically wants to stick with brick and mortar real estate.
Great. Well, you all are good at what you do and you know it very well. Thank you, Austin, for the full overview. Everyone will be sending you the recording tomorrow along with the slides. If you didn't catch the two links in the chat for the free resources and the consult, that's going to be in the follow-up email as well in case you missed it. We have another webinar coming up, actually two coming up next week, another investment opportunity and also insurance. So we're going to be talking about insurance rates and how we can get a better rate on our rental properties. So I hope you all will see that in the upcoming email as well. I'll put a link to those next webinars. And Austin, thank you so much for staying extra and talking to our group. And we'll provide your contact info or your real estate transition solutions info as well to our members tomorrow.
Excellent. My pleasure. Thank you, Alexandra.
All right, everyone. Have a wonderful day. Bye.